Now that you know what capital assets are, let's turn to the treatment and compare the capital asset gain or loss treatment between individuals and corporations. So, if an individual sells a capital asset for a gain, it gets preferential treatment. That's better than ordinary rates, right? They get those 0, 15, or 20% preferential rates. Of course, we have a 25 and a 28% rate also, but preferential rates, right? What if an individual has a capital loss rather than a capital gain? Well, remember, that's not so preferential treatment. They're limited to $3,000 per year. Of course, we can net those maybe with capital gains to try to gobble them up. But if we just have a capital loss, you can only take 3,000 of that a year. What about carry back, carry forward? Stop the video and see if you can remember those rules. Okay, for individuals, they can't carry this loss back. They may only carry it forward and hopefully get to use it up next year, the next, and so on. They can carry it forward indefinitely, so there's no certain time period. All right, let's compare that with corporations. First of all, think and again, stop the video. Tell me a type of capital asset a corporation might have. Go through that list of what a capital asset is not. So corporations can actually own stock in other corporations. That could be a capital asset. They might hold some land that they're not using in their business. They're just holding it for investment. So those are a couple of examples. Okay, what if, so up here we said these are capital gains and these are capital losses. What is the capital gain treatment for corporations? Well, boo, no preferential rates. No preferential rates. So how do they get taxed? Just at a corporation's ordinary rate. And what is that? 21% ordinary rate. Remember, corporations don't have the progressive tax rate system that US individual income taxes do. Corporations just have flat tax, 21%. Okay, so no preferential treatment there for gains. What about losses? Maybe they get a preferential treatment for losses. No preferential. I don't know why I put an R up there. No preferential treatment for losses either. They don't get to take this $3,000 even limited. They just get not squat. So up here I have my example. Say in year 5 of an individual's life or a corporation's life, they sold a capital asset for 100 grand. Their adjusted basis was 150. They have a realized loss of 50. If they're an individual, how much can they recognize? Just 3,000, right? What about a corporation? Nada, not squat. They don't get to recognize any of it. So what can they do? What about their carry back, carry forward? Remember, individuals, no carry back. Corporations, yes. They can carry back 3 years and then carry forward 5 years. So in our, ooh, that's light. Hopefully y'all can see that. In our example here, what would they do? If this occurred in year 5, the rules are you go back to your furthest year. So we would go back to year 2 of the corporation and see if we can use the loss. And then year 3, and then year 4. That's our carry back for 3 years. And then if we still haven't used it up, then we would go, I'll do my 2, 3, 4. Then we would go to year 6, year 7, year 8, year 9, and year 10. So we have 8 possible years in which we could use up this $50,000 loss. What happens if we still don't use it up? We haven't run across any capital gains. Then it's gone. You missed your chance. It's not like individuals where you have indefinite opportunities. So over here, I'll say carry back, no, carry forward indefinitely, just so that you can compare those two. So you really need to plan, I mean, honestly, in both scenarios, to find some kind of maybe capital asset that you might be willing to part with that you could incur a gain on in order to be able to gobble up any of that loss. So that's your comparison between individuals and corporations.